I'm Farhan Lalji. I'm principal at Anthemis Group. I've got the investment side with Anthemis, where we've been investing in companies that both enable open banking, like TrueLayer, but also kind of companies that are at the edge of producing both consumer and business solutions leveraging open banking. Anthemis is one of the world's leading fintech-focused VCs, and we invest in early-stage companies that are going to disrupt and innovate in financial services. Alongside that hat, I'm also one of the judges for the Open Up Challenge that was presented by Nesta and the Open Banking Implementation entity. So if I think about things from a challenge perspective, two of the winners primarily are helping people on their savings side so that when kind of an emergency does come up or when some unexpected expense comes up, people have that kind of savings to be able to dip into rather than needing to borrow. At the same time, kind of alongside Moneybox and Plum, you had Mojo Mortgages. What they are doing is helping people to think about what they need to do in order to get to a point to be able to get a mortgage, right? How do you get kind of stronger from a financial services perspective and your own kind of financial needs to be able to then afford that home? And then you've got Wagestream, which instead of, people going to a payday lender or going into, a lender that's not necessarily going to have the best interests of the individual, what Wagestream is trying to do is give people kind of access to their salary and their earned income sooner rather than later. For me, kind of now flipping onto the other side as an investor, I'm kind of looking at this as a massive opportunity for startups, right? Because people are, kind of not necessarily having great credit scores because something that might have happened 6 years ago. And if you've got companies that can look at affordability for leveraging open banking, and don't get me wrong, there's still a ways to go in order to get the data classification and everything else right. But you can get some really good signals in terms of understanding the customer's ability to afford some kind of lending product. And it's a shame that the Main Street lenders aren't doing that, but it's an opportunity for a lot of companies, including those that won the competition, but also others leverage that data and offer these customers that maybe had some unforeseen experience several years ago. I mean, personally, I'll give you a personal anecdote. When I had my first company, I had maxed out credit cards. I had kind of gone into some really bad debt in that first company as I was trying to kind of like navigate out of the previous crisis in the real estate market. At the same time now, kind of, am I a good kind of aspect to lend to or a bad aspect to lend to? From a credit scoring perspective, there was a time where it would be difficult, right? But kind of luckily, I had a safety net, but a lot of people don't have that same kind of safety net. And for some kind of reasons, if you can find a way to kind of show, hey, this person can afford that loan, rather than that kind of intermediate credit scoring, I think it is an opportunity to give people a hand where you can. The high street banks or the lenders and what's in it for them. I mean, I think the thing that's important to realize is that, right now, the view is not around kind of stakeholder and society. It's still around shareholder, right? And alongside the shareholder consent and the shareholder optimization, you've also got loan to deposit ratios, right? And if I can make more money as a high street big name lender selling a mortgage or whatever it is, rather than giving somebody, kind of a means to be able to get through to their next payday or whatever it is, right? You're going to take the more profitable loan right now, right? But that creates an opportunity. The other thing to realize is that, their cost base is a lot higher. Fundamentally, they're going through a digital transformation for a lot of these mainstream lenders themselves, but they still have a lot of bricks and mortar. They still have a lot of staff. They still have a lot of overhead that they need to account for and be able to turn a profit on top of that, which is why there's a huge opportunity both for startups or for some of these new lenders or for people who've got a balance sheet that can lend off that balance sheet in order to provide, some of these gaps, filling those gaps with kind of alternative means to service a category and service a consumer base that's looking for means like this. I'd say it already is. I mean, I think it's, kind of at that cusp of tipping over into really influencing it and really disrupting it. But when I look at kind of the competition from an open up challenge perspective, I think all of these companies would have taken several years later, right, to implement and have kind of that kind of impact, whether it is from an affordability to a salary, to a savings, to a mortgage, right? If you think about all of those, right, all of those kind of groups whether it's people right at the edge or people who are trying to kind of stay on that treadmill and move up different kind of spectrums. I think they're all benefiting, from these kind of companies and from these innovations that open banking is allowing, kind of for customers and for startups and for some of the larger companies to really kind of take advantage of. And I think it's off the back of a lot of infrastructure that's already happened when I think of companies like TrueLayer. And I think it is from companies at the edge that are trying to be even more innovative, like Wallet or Flux or Wagestream or Mojo or any of these companies that are really helping to kind of plug some gaps here.